Hello, this is Jason Wenke, and thank you for checking out today's market update video. Today is Monday, August 9, and it's about 2 o'clock in the afternoon, so a couple hours left of the trading day. I haven't been able to do a market update video in a few days, and really for two reasons. One, if you can't tell, I've been fighting a bit of a cold, so I haven't had much in the way of a voice since about last week, Wednesday or Thursday. And then the second reason is if you look at this chart, this is the S&P 500 daily chart. This is looking at the last 12 months. And the reason I pull this up is that there hasn't been much of a pattern developing yet. So it's a bit premature for me to take a look at the charts and tell everybody what the market may do from a technical perspective. If we look at the top right of the chart, we can see these last few days, the market has been trying to, it's in what a lot of traders will call a consolidation period. It's when the market sort of trades sideways. So it's the same point today that it was about mid-July. It hasn't really gone anywhere, whether it be good or bad, in the last 30 days. After the market had its sell-off, which happened in May, it wasn't a huge sell-off, but a mild correction, we'll call it, about a 6.8% correction, coming on the heels of Ben Bernanke's May 21 announcement that the Fed would start tapering off their bond buying activities. The market found a bottom of that correction, the S&P 500 that is, around 1575. And from that point it's rallied up over 100 points. So it's had a nice recovery, went back to an all-time high the first couple days of August. Then it's just had, four of the last 5 days have been slightly down. But what's happened is that the former trend that we were in, which you can see the pair of blue horizontal lines that started last November and kind of went all the way up until late May of this year. When the market fell through that and found its bottom of the correction and rallied back up, now it's having a hard time getting back into that zone. You see that it's been kind of bouncing off the lower level of that trend. And this is not all that uncommon. We saw a similar thing happen in 2012 where the market had a nice trend for quite a while, went up about 15% altogether, had a correction, and then it started a new trend. But the trend was, obviously started initially lower than the old one. You can see that by last year's trend, which is the two black bars here that move horizontally, and then the correction, which was 8.5%, and then the more recent rally. So what we're waiting for is to see if this new trend actually develops and becomes a new set of rising parallel bars. That would be an uptrend. Or it is very possible that the market could actually have hit its high already for the year and a regression of sorts could start. Right now it's a little too early to tell either way, which is that's why this is the second reason I haven't done a market update video. There's not much to actually look at and draw much conclusion. Economically, the U.S. economy is still growing, but it's growing rather tepidly. So it's not like we're having great growth. So as a result, it's hard for the market to continue to increase in price. If earnings aren't growing and the economy is not growing, it's a little bit difficult to justify 10, 15, 20% growth consistently from the stock market. One of the big benefactors to the stock market has been the problems in the bond market. So if we look at the bond market, and I'll pull up a bond chart. And what we'll notice when we look at the bond market is that it still hasn't recovered. Unlike the stock market, this is a weekly chart, so it's looking at 5 years, just to give us a little longer term view on the bond market. We've had a really nice long-term, multiple-year uptrend. It hit its peak in May, and then since that same announcement in May, it had a 5% correction, which for bonds, that's a pretty major correction. Since then, bonds have come up a little bit, about 1.5%, but they're still 3 or 4% below their all-time high. So bond investors are still probably feeling a little frustrated because they haven't had the same type of recovery. Really, the only recovery has been the interest that's been being paid each month the last 2-3 months. And as far as the next direction in bonds, it's hard to say exactly where it'll be because, again, there's not a fully formed trend. We don't know if this is going to be a new downtrend and it gets substantial. The only way that would happen is if interest rates continue to rise. And the reality is the likelihood of them rising in the same type of trajectory that they rose in May and June is pretty unlikely. And the reason it's unlikely is that the Federal Reserve is not going to raise interest rates. They might slow down their bond buying activity, which is what caused this initial drop, but they're not going to start raising interest rates unless the economy is really improving at a hearty clip. So I think that what's going to likely happen is, much like what we've seen in the stock market, we'll see continued consolidation of sorts in bonds where they'll trade sideways for some time. But eventually interest rates will start to go up, and it may happen late this year. It may happen in 2014 or 2015. We just have to know that if we're a bond investor, our expectations need to be really modest. If we have returns that are between 1% and 4% from a bond portfolio, that's likely all that someone should expect. There is always a chance that bonds would lose a small amount of money in the initial years of a long-term interest rate rise. But unlike stocks, bonds don't have the same ability to lose 40, 50, 60% in a matter of 12 months. I mean, it would require interest rates to jump at a pace that's not, really unthinkable to have those types of declines. So for bond investors, it just becomes frustrating, but it's not devastating. When stocks really correct, it can be devastating. So just kind of keep that in mind if you're a bond investor. A lot of our clients, we do keep a lot of allocation towards fixed income because we work with a lot of folks who are retired. And as a result, a conservative investor in a year like this is really likely to have very small gains because the bond market is frankly negative for the year, just a couple percent, but still negative nonetheless. On the flip side, the stock market, which we're just looking at, is so close to its all-time highs, it's difficult for people to rotate, so to speak, out of bonds and then buy into stocks. If we look at the same 5 years of a weekly chart of the S&P, so this is the exact same time period we looked at, but in this case, the stock market compared to the bond market, we see that stocks have had a very nice run. It's in an uptrend, but stocks are actually awfully close to their all-time high. And there's a lot of signs that are showing that this market is getting a little bit long in the tooth. You can see at the top of the chart, this is the relative strength of the S&P. When it gets these green peaks at the top, it shows that the market's overbought. When it gets overbought, it's just due for a correction. It doesn't necessarily mean it's due for a crash. The last 2 times before 2013, the market got this overbought. It had a 13% correction and a 15% correction. This time around, it's been staying overbought for quite a while, for really about 4 or 5 months. It's had 3 different times where it's peaked up into this overbought territory, and it's yet to have that same type of a correction. So I think it is coming. I just don't know how soon it'll happen. The last time that we had the correction, keep in mind that the market was in these similar type overbought conditions in February of 2011, but the correction didn't come until September and October of that year. So it took about 4 or 5 months for the market to consolidate, trade sideways, then eventually have a correction. That very well could be what happens this time around, is that from the initial time the market gets overbought, it takes 6 months or longer for it to sort of consolidate and then correct. And that's normal. It's not, again, fun if you're an investor to go through corrections. But when corrections are modest, they're not devastating. It's the ones like we see at the very far left of this chart in 2008 where markets go down 40, 50, 60%. Those are the things that we really, really have to be careful to avoid. So where we are today anyway, again, there's nothing that can tell us exactly what's going to happen. My best guess, and that's really all that is when there's nothing really formed, is that we're likely to be in a consolidation period where the markets trade sideways for a bit. I do expect there to be a bigger correction than what we saw. The biggest correction we've had this year is just 6.8%, and markets are up pretty substantially for the year. So any bit of bad news might send the market into not necessarily a free fall, but an actual healthy correction, which may be in the 10% or more range. So I'll keep everybody up to date as I see patterns develop and trends develop. I'll make sure that I post a market update video. Until then, I hope everyone is well and enjoying the summer, and I'll be back in touch soon. Thanks again.